This is the Amplify ETF's second quarter review of the Amplify CWP Enhanced Dividend Income ETF, symbol DIVO. Joining me is Kevin Simpson from Capital Wealth Planning. So when you look back on the second quarter, what changes did you see in the portfolio?
Second quarter was powerful from a market perspective. We had a few positions called away, some of which were in the process of re-entering. An example would be Apple and Home Depot and Dow Chemical. Give you three, all of which were called away, all of which we were able to re-enter and rebuild some of those positions along the way during pullbacks. And one that we have our eyes set on, which was called away, is Caterpillar. Now, Caterpillar peaked out around 245. I think we exited anywhere between 225 and 235. Of course, it went a little bit higher, as is sometimes the symptom of the covered call strategy. But things don't go up forever, Jay. Stocks don't always go straight up. Sometimes they actually go down. And Caterpillar right now is trading just over $200 a share. And at this point, as it's showing and displaying some weakness, it's certainly becoming a candidate for us to re-enter. So we bought back Home Depot, we bought back Apple, we bought back Dow Chemical, not all in full positions just yet, and Caterpillar's on the horizon as a re-entry position.
Is there anything you removed from the portfolio that you don't currently have your eyes on?
Pepsi's not in the portfolio right now, and to say that we don't have our eyes on it might not be the best answer to your question, but it's performing pretty strong, and at this point, it's not a candidate for re-entry, but we love the name, and if it does experience some weakness, we'll certainly revisit it.
Excellent. So, Kevin, as we sit here in the middle of 2021 and you look to the second half of the year, what do you have your eyes on?
Chad, I think you have to look at inflation and interest rates for the second half of the year. Inflation is the scary word. Hyperinflation is something that none of us want to see. We don't want to return to the 70s. Gas lines, high interest rates are problematic. So it's really not an inflationary issue. It's more of an interest rate issue. And they've come back. They've surprised the markets. I mean, the 10-year is trading at levels that we probably none of us expected if you want to know the truth. But a little inflation makes sense. I'd be more concerned if there wasn't some inflation. We hear the Fed talk about transitory, temporary inflation. I think it's probably a little bit more permanent, but we don't want to see it too high, too hot for too long. And again, corporations, corporate earnings can do quite well in an inflationary environment as long as there's not too much inflation.
To learn more about the DIVO ETF, please visit amplifyetfs.com/DIVO. Kevin, thanks for coming on.
Thanks for having me, Jay.